Welcome back. Ready to go back to 1985 with me? Let's step into the next chapter of the story, where the US economy was changing fast and Buffett was leading Berkshire Hathaway to an entirely new level. In 1986, the United States economy was at a critical turning point of the late Cold War era, characterized by low inflation, slowing growth, regional recessions, and a historic overhaul of the tax system. While the U.S. was in the middle of a multi-year economic expansion fueled by Reaganomics, the pace of that growth slowed down significantly by 1986. Buffett presented his insights during this exact period, an era where top-line inflation seemed stable, but the fundamental tax structure of corporate America was being aggressively reshuffled. He used this backdrop to brilliantly show shareholders that a tax cut is not a universal blessing. Rather, it is the ultimate diagnostic test of a company's core pricing power. In his 1986 letter to shareholders, Warren Buffett explains that the distribution of tax cuts depends entirely on business franchises and government regulation. Companies with strong economic moats, like the Washington Post back then, retain the tax savings entirely as shareholder profit, rather than passing them to consumers. This framework reveals that tax rate changes act as a diagnostic tool for a company's competitive advantage, proving that only businesses with pricing power truly capitalize on tax relief. Buffett categorizes corporate tax cuts into regulated utilities and fiercely competitive commodity industries, noting that for both, tax windfalls eventually flow to consumers, whereas companies with powerful business franchises retain the tax profits entirely for themselves. He uses the witty analogy of a top-tier brain surgeon to explain that elite businesses command pricing power based on irreplaceable value, completely decoupled from their operational tax costs. Concurrently, he issues a sober warning that the low tax policies of that era were unsustainable, predicting future macro crises in the form of either higher taxes or surging inflation. Breakdown of Buffett's economic categories. The two regulators. Administrative boards control public utilities directly, while intense market forces act as an unofficial utility commission to strip commodity businesses of tax gains. The brain surgeon. Advantage. Unregulated, high-moat businesses set prices based on user utility rather than cost-plus margins, transforming 100% of tax reductions into net earnings. The fiscal illusion warning, aggressive tax cuts paired with swelling government deficits create an unsustainable fiscal vacuum that historical forces inevitably balance through inflation or tax hikes. This historical data perfectly validates Buffett's 1986 five-year macroeconomic prophecy. The subsequent fiscal crisis, resurgence of inflation, and forced tax hikes under two different U.S. presidents proved that unsustainable tax cuts without fiscal discipline are merely a temporary illusion. Prophecy fulfilled, inflation and interest rates spike. Inflation doubled. U.S. inflation sat at 1.10% during the 1986 tax reform, but doubled to 4.42% by 1988 when low rates took full effect. By 1990, exactly at the end of Buffett's five-year window, inflation rocketed to 6.11%. Aggressive hikes. The Federal Reserve dragged the federal funds rate close to 10% to curb prices, which triggered the early 1990s recession. Prophecy fulfilled. Broken promises and tax rate reversals. Income tax hikes. President George H.W. Bush broke his "read my lips, no new taxes" pledge, raising the top rate to 31% in 1990. President Bill Clinton pushed it to 39.6% in 1993. Corporate tax reversal. The Clinton administration raised the top federal corporate tax rate from 34% back up to 35% in 1993, officially ending the aggressive low-tax era of the mid-1980s. Buffett's foresight demonstrates a fundamental law of macroeconomics. Temporary tax windfalls not backed by healthy fiscal balance will always be clawed back later through inflation or higher taxes. In this section, Buffett deconstructs the structural damage inflicted upon the insurance industry by the Tax Reform Act of 1986. He illustrates how the acceleration of tax payments strips insurers of their most powerful weapon, compounded float, and explains why a fragmented tax landscape prevents them from passing this cost on to customers. 1. Fatal front-ending of taxes, stripping the time value of money. The new rules. The law required property casualty insurers to discount loss reserves for tax purposes and include 20% of unearned premium reserves in taxable income. The cash flow shock. While this did not change the total nominal tax liabilities over the long run, it aggressively accelerated the payment schedule, front-ending what was previously deferred. The 21-year-old prodigy metaphor, paying taxes early is economically ruinous. It is akin to being forced on your 21st birthday to prepay all income taxes you will ever owe in your lifetime, drastically reducing your terminal wealth. This brilliant diagnosis highlights why the insurance industry can be uniquely brutal. Macro tax policy changes do not hit everyone equally, completely fracturing the industry's pricing coordination. Buffett's point is that the 1986 tax reform created a brutal shakeout in U.S. property and casualty insurance. Some rivals could ignore taxes because of losses or corporate structures, so pricing became chaotic and many insurers had to absorb the tax burden themselves. Berkshire did not chase the price war. Instead, it cut back on uneconomic business, used its fortress balance sheet to dominate large reinsurance and catastrophe risks, and kept generating low-cost float. That float let Buffett invest in great businesses and compound capital, so the real advantage was not just surviving the industry chaos, it was using patience and capital strength to become even stronger while weaker competitors self-destructed. Buffett highlighted two important tax changes in the 1986 Tax Reform Act. First, insurance companies received a one-time fresh start adjustment, which temporarily softened the transition to the new tax rules. For Berkshire, this created a short-term tax benefit, but Buffett warned that it was only a temporary gain, while the other tax changes would have a much larger long-term negative impact. Second, the act repealed the general utilities doctrine, which had previously allowed companies to liquidate or sell assets without paying corporate-level capital gains tax. After the repeal, asset-heavy companies faced a new layer of tax at the corporate level before shareholders were taxed again on distributions. Buffett pointed out that this dramatically reduced the real value of companies such as oil and gas firms, media businesses, and real estate companies, because a large portion of their liquidation value would now be lost to taxes. His broader lesson was simple. Investors should not mistake one-time accounting relief for true long-term earnings power, and they must always consider how taxes affect the value that ultimately reaches shareholders. The repeal of the general utilities doctrine in the 1986 Tax Reform Act had a direct and crucial link to the late 1980s LBO boom and the wave of bankruptcies that followed in the early 1990s. This was not just an accounting change, it removed one of the most powerful tax advantages in the leveraged buyout game and structurally distorted the entire M&A ecosystem on Wall Street. Looking back, Buffett's 1986 analysis reads like a forecast of the LBO bust that followed. While Wall Street was still intoxicated by the idea that any company could be bought with enough borrowed money, Buffett saw that the tax system had quietly raised the cost of corporate restructuring by a huge amount. Berkshire stayed mostly on the sidelines during the LBO frenzy. Then, when the bubble burst and assets became cheap again in the early 1990s, Berkshire had the cash and patience to buy well, while others were forced to sell. In 1987, Warren Buffett made a point that still separates great investors from the rest. Book value is not the same as business value. Book value is only an accounting record, but real investment value comes from the cash a business can generate, the earnings of its subsidiaries, and the quality of the people running it. That's why Buffett focused on per-share business value, not just what Berkshire showed on paper. In this video, we'll unpack what he meant, why Berkshire's economic value kept rising faster than its book value, and how investors can think about the same idea today. Warren Buffett's 1987 shareholder letter gives us a rare quantitative blueprint for what he calls business superstars. His point is not that great companies are flashy or highly leveraged, but that they are built on capital efficiency, discipline, and focus. In Buffett's reading of the data, elite businesses share a few clear traits. They generate high returns on equity over long periods, avoid dependence on heavy borrowing, and usually operate in plain, ordinary industries. Their edge does not come from constant reinvention, but from doing simple things extremely well. selling more of the same products, raising prices carefully, and protecting their economic moat. Buffett also uses Berkshire's insurance businesses to show how the economics work in practice. The key metric is the combined ratio. Below 100 means underwriting profit, above 100 means underwriting loss. But insurers can still make money through the float, which is the cash collected upfront and paid out later. In a favorable interest rate environment, even a combined ratio slightly above 100 can still produce a break-even or better result once investment income is included. The deeper lesson is that great businesses do not need complexity to create value. They need durable economics, strong management, and the ability to convert ordinary operations into extraordinary long-term returns. Buffett's 1987 letter gives one of the clearest explanations of insurance economics ever written. His warning is simple. When premium growth slows well below the industry's break-even rhythm, the insurance party is over. He argued that the real pressure in insurance is not just ordinary inflation, but social and judicial inflation. Higher verdicts, broader liability interpretations, and a legal environment that quietly pushes claim costs higher. In that world, premium revenue needs to grow about 10% a year just to keep up. If growth drops to 4% or 5%, underwriting losses start building fast. Buffett also explained why the damage does not appear instantly. Insurance contracts run on a lag, so companies often still enjoy the benefit of old, profitable policies even after market conditions have turned. That is why the downturn can look mild at first, then become much more painful later. The deeper lesson is that insurance is a commodity business unless an insurer has a genuine cost edge or a special niche. GEICO won by being a low-cost direct writer. Berkshire won in select areas by using its balance sheet strength to serve situations where long-term reliability matters more than price. Berkshire's real moat is not just capital, but trust. In insurance, that financial strength matters most when the market is stressed, the claim is complex, and the buyer cares more about certainty than price. In normal retail insurance, that advantage is weak. Auto and homeowners coverage are commoditized, state guarantee systems protect policyholders, and in good times, buyers usually choose the cheapest policy anyway. But in long-tail liabilities and catastrophe reinsurance, Berkshire's balance sheet becomes the product itself. When the claim may not be paid for 10 or 20 years, or when a disaster freezes the market, the insurer that can absolutely survive is the one clients want. Buffett also explains why GEICO and Progressive beat the commodity curse in very different ways. GEICO won by cutting cost through direct-to-consumer distribution, eliminating the agent commission structure, and passing savings back to customers. Progressive won through information advantage, better data, better risk selection, and better pricing through telematics and analytics. The deeper lesson is that insurance is not really about selling a policy. It is about building a structure that can survive price wars, bad cycles, and unpredictable claims without destroying capital. Buffett's 1987 letter goes far beyond insurance. It exposes a deeper truth about accounting, taxes, and investing. Reported earnings can look strong while real business value is moving in the opposite direction. First, Buffett attacks the weakness in long-tail insurance accounting. In businesses where claims may be paid decades later, profit depends heavily on loss reserves. That creates a temptation for dishonest managers. Underestimate future claims, inflate current earnings, and let the numbers look better than reality. Buffett's point is not that auditors can predict the future perfectly, but that they should be honest about how uncertain these estimates really are. He then shows how tax law can distort economics. The 1986 Tax Reform Act created a one-time accounting boost for Berkshire, but that did not mean Berkshire had become more valuable. In fact, the law increased future cash taxes and reduced long-term value. What looked like a gain in reported earnings was really a drag on business economics. Buffett also explains how the tax code penalized corporate intermediaries. When Berkshire earned dividends and bond income through its portfolio, the after-tax result was worse than if the same income had been held directly. The lesson is classic Buffett. Always separate accounting noise from real economic outcome. The same mindset shows up in his famous Mr. Market passage. The market is not your teacher. It is your partner, and often an irrational one. Sometimes it offers absurdly high prices, sometimes absurdly low ones. Your job is not to follow its mood, but to use its mood if you understand the business better than it does. That is why Buffett mocks complex finance jargon and market theory that tries to make investing sound more precise than it is. In his view, the formula for success is simple: good business judgment plus emotional discipline. The final lesson is timeless. In the short run, the market votes. In the long run, it weighs. If a business is compounding value, patience will eventually matter more than price quotes. Buffett's 1987 capital allocation discussion is really about one thing: keeping Berkshire ready for opportunity while refusing to let short-term accounting distort long-term judgment. He held roughly $900 million in municipal bonds as a parking place for cash, not as a permanent investment. Because Berkshire had bought them before the tax rules changed, they remained fully tax-exempt, making them a useful temporary home for capital until a better opportunity appeared. But Buffett still saw them as second best to true operating businesses or exceptional stock bargains. His warning on long-term bonds is even sharper. A bond is only a claim on a currency, and if that currency loses purchasing power, the bond's real value can collapse even if the nominal coupon looks safe. That is why Buffett stayed wary of long maturities and believed even medium-term bonds might be too exposed to inflation risk. He then expands the lesson to the broader U.S. economy. America's trade and fiscal imbalances, in his view, created a dependence on the kindness of strangers, foreign investors funding U.S. deficits in exchange for claim checks that could later be paid back in weaker dollars. That is a powerful way of saying that debt can look harmless until currency debasement slowly transfers wealth away from creditors. The WPPSS bond example shows Buffett's flexibility. Even though he disliked bonds in general, he would still buy one if the price was misjudged enough to create a major edge. In this case, the numbers gave Berkshire a tax-free yield of about 14.17%, which made the investment attractive despite his broader skepticism about fixed income. The key lesson is that Buffett does not follow rigid rules. He prefers to stay liquid, avoid long-duration traps, and only commit when the edge is large enough to overcome the structural risks. Berkshire raised $250 million through 30-year bonds at a fixed 10% rate, but since no major acquisition was available yet, that cash was temporarily parked in safe short-term instruments earning only 6.5%. The result was a negative carry of about 3.5 percentage points. Buffett said that losing roughly $160,000 to $168,000 a week on that spread did not bother him at all. Why? Because Berkshire was not trying to maximize short-term yield. It was trying to stay ready for a rare, beautiful acquisition, the kind of elephant that can appear suddenly and disappear just as fast. His logic was that if Berkshire found one truly outstanding business within 5 years, the long-term gain would dwarf all the small losses from waiting. In other words, he preferred to pay for readiness rather than force capital into mediocre uses. Berkshire borrowed $250 million at 10%, then parked the money in safe short-term instruments earning 6.5%. That created a small weekly loss, but Buffett didn't care. He knew that if the right acquisition appeared, one great deal could more than repay years of waiting. Buffett is showing that good capital allocation is not about avoiding every cost. It is about accepting small, temporary friction when it preserves the ability to act decisively on a truly exceptional opportunity. Buffett's 1988 shareholder letter is a masterclass in financial integrity. His message is simple: accounting numbers matter, but they are only useful if they help investors answer 3 questions: what a company is worth, whether it can meet its obligations, and how well management is doing with the capital it controls. He then draws a hard line between honest accounting judgment and outright manipulation. Some managers smooth earnings because they want reported results to better reflect reality over time. But Buffett warns that others are charlatans, using accounting creatively to make weak businesses look stronger than they really are. His point is that a pen can be used to steal far more effectively than a gun. Buffett also explains how regulatory changes distorted Berkshire's financial statements. In 1988, new consolidation rules forced Berkshire to combine more of its finance subsidiaries directly into the parent company's results, which made the statements harder to read. To fix that, Berkshire began publishing supplemental segment data so shareholders could see the business more clearly. Then came the 1990 deferred tax change, which created another accounting shock. Berkshire had embedded stock gains taxed at older rates, but the new rules forced those gains to be remeasured at a higher tax rate, creating a large, non-cash write-down. Buffett's point was that this reduced reported book value, but did not necessarily change the underlying economic reality. The closing lesson is classic Buffett. Investors should trust Berkshire not because of clever accounting, but because of alignment, integrity, and the golden rule. Charlie and he had their own money invested alongside shareholders. They chose managers who truly cared about their businesses, and they intended to treat shareholders exactly as they would want to be treated themselves. Buffett says many companies judge workers fairly at the bottom, but excuse poor results at the top. He argues that boards often protect CEOs instead of holding them accountable, while market theory can mislead investors into thinking prices are always efficient. He also shows that careful analysis, discipline, and proper accounting adjustments reveal a business's real economic performance. Buffett's 1989 letter argues that intrinsic value is the present value of all future cash a business can generate, and that Berkshire's book value increasingly understated its real worth as its operating businesses became stronger. He also says Berkshire's big gains came from both business growth and valuation re-rating, but that future returns would likely depend more on ordinary operating compounding because the market had already recognized much of the hidden value. He also highlights Berkshire's insurance strength. It can stay out of bad catastrophe business when pricing is weak, but act aggressively when panic creates unusually attractive premiums. On Coca-Cola, he shows how long-term consumer brands can become extraordinary compounders once good management unlocks their global potential. Buffett then shifts to capital allocation and criticizes Wall Street debt excesses, especially zero-coupon, PIK, and EBDIT-style financing that hides real cash strain. His point is that good investing requires looking through accounting gimmicks to true cash flow, staying disciplined, and preferring wonderful businesses at fair prices over mediocre businesses at cheap prices. Next video, we're going into Buffett's 1990s shareholder letters, what happened in Berkshire, what changed in America, and the lessons Buffett left behind. Don't miss it.